Good afternoon and welcome to the Smartspace Software PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Frank Beechnor, CEO. Good afternoon to you, sir.
Good afternoon. Thanks very much, Alessandro. This is Christian Shaw, CFO. My name is Frank Beechnor. I'm the CEO. Thank you for sparing the time this morning to allow us to give you an update on performance for the half year to the 31st of July 2023. So we'll go straight into the presentation.
Okay, just jumping into the financial highlights, just to point out that all of our numbers are now excluding the A&K business, which was disposed of in July 2023. And so that removes all of the revenue and the costs from relating to that business for both the current period and also the comparative periods. We're now therefore a pure SaaS business, very much focused on growing our revenues at a very high margin. You see here that the revenue for the first half of the year was up 16% on the comparative period, and the ARR was also up 21% on the comparative period as well. As mentioned there, we've got a very high gross margin, 92%, which is up in comparison to the comparative period. And therefore, all of that growth in revenue will feed down into the bottom line now. Our admin expenses were down 3% on the comparative period. We believe that going forwards, we can maintain that admin expense where it is, obviously subject to the inflationary pressure on that, but we don't see any need to grow the admin base of the business to grow the revenues. Therefore, that growth in revenue will feed down into the adjusted EBITDA, which you can see has improved in comparison to the previous period. We're at just a small loss for the first half of the year. And we expect again for that to move towards the break-even level into future periods. We're stable from a cash position. We had a small cash burn the first half of the year, but as I said, the growth in the future periods will make sure that turns into a break-even and cash flow positive in future periods. And the cash at the end of the first half of the year was 2.2 million. We had a small amount of payments which are still due to go out on relating to the disposal of A&K, and therefore the cash balance as of 30th of September was 2 million. These graphs here just show you the growth in the recurring revenue. On the right-hand side, you'll see the annual recurring revenue, which we measure on a constant currency basis, and you can see that that's continuing to grow period on period. And we believe that will continue to grow in the future periods as well. On the left-hand side, you see the recognised revenue, which is exchanged at the exchange rates at the time when the revenue is recognised, and therefore there was a little bit of a dampening effect on the first half of this year in comparison to the previous periods. Because of the foreign exchange movements, we expect that going into future periods that will actually benefit us rather than be a bit of a headwind, and therefore that's a bit of a one-off effect that we saw in the first half of this year. The ARR continued to grow in the 2 months after the 31st of July, so it was up to 6 million as of the 30th of September. That's up 10% from the start of the year. And as I mentioned there, the cash balance at the 30th of September was 2 million. We've got no debt within the business as well.
Obviously, as the year progressed, our ARR increased, so it's up 21% year on year to 5.8 million by the end of July, and it's grown again to the end of September to 6 million. Our ARPU is also up by 9%, so that's where we actually sell more functionality to existing customers, either to extra locations or to extra functionality. We spent the last year working on a very large software project development we call Spaces, and it's an extension of the Swipe Down platform that takes Swipe Down and moves it beyond visitor, allows customers to book desks, meeting rooms, etc. And that will be sold back into the existing base. And we expect that to positively impact ARPU as we move through the rest of the year. But there is no Spaces revenue in that ARPU number that we cite there. Customer numbers, we seem to have got back to the momentum prior to COVID, and we're now at 5,112 customers at the end of September, is 11% up year on year. So there's good momentum back there. And then that's across all our core markets, including the US, the UK, and Australia in particular. And we've also added some new markets as well, but the numbers that they'll contribute are smaller. One major achievement in the year is the reduction in CAC. The marketing team have done an amazing job. You might remember from previous presentations, we've brought our marketing function back in-house. We now do all our Google AdWord buying and digital marketing internally. The net effect of that is that our CAC has gone from roughly £1,600 to just over £1,000, 37% reduction in the period. We have a relationship, as you probably are aware, for those of you that have followed us over time, with Evoco. There was a development there in August when it was announced that Evoco was acquired by a US business called BIAM, who were in the meeting room and I suppose large environment amplification space, so sports stadia and that kind of thing. They acquired Evoco because they wanted to build out their meeting room panel capability. We see this as a positive for NASO. They've now got a new owner at Evoco. Clearly will put a lot more pressure on them to start shifting panels where we bet, and we obviously benefit from those in terms of royalty and ARR. We're not expecting that to have an immediate impact. The deal only concluded at the end of August, and they're in the midst of integrations right now. But as soon as that's concluded, we expect to see an uptick on the Evoco NASO product revenue line for that comes to us. Yeah, so I mean, it's one of those parts of the business where we've been waiting for it seems like forever for it to generate serious revenues. But with the introduction of Evoco into BIAM, we've got a very large footprint globally in terms of resellers and salespeople, and not just in North America, but in Europe and the Middle East and Far East. It can only help that deal flow and ultimate revenues that come to us from Evoco. In terms of where we go from here, our focus now that we're a pure play SaaS business is to focus on software. What we have noticed in the last six months is the US and the UK have been very strong in particular, and Australia seems to have come back a little as well. We got active in a number of overseas markets, including Taiwan, China, and then South Korea. We don't have a lot of costs associated with those markets, so we'll keep those ticking over. And we also entered the German market this year with a fully localized German product. We're actually going to start delivering those German sales from the UK. We use a third party firm to do that. And whilst they did a good job at the top end of the funnel, we didn't feel that they were delivering at the bottom end in terms of getting close customers. And what we also found through the experience of working with them, that a lot of the German customers were happy to converse in English on the basis the whole product was in German. But the focus really going for the next 6 to 12 months will be to really push on the US and the UK market. We don't plan. We've got the product ready in another language, but we're not going to push on that in the immediate term. On the basis we've got quite a small marketing team, and it's a big marketing exercise to sort of get into new markets. We obviously Spaces is the biggest opportunity that we've had to really increase the ARPU across the 5,100 customers in Swipe Done. Now that that's out, we got our first signed customer at the end of August. We only started promoting into the broader Swipe Done base towards the end of September. We need to give that a few months now to bed in. We still have some work to do on the product itself. We haven't introduced meeting rooms yet, and we've got other areas of functionality. But by the end of this financial year, at the end of January, we should be in a good place. And the scale impact of that is actually really high, on the basis that a typical Swipe Done customer right now might be paying us $50 or $100 a month for a reception for a visitor. If they actually had 100 desks upstairs that they wanted to manage and maybe 50 car parking spaces, that's 150 times $4 a month. So probably 3 or 4 times what we get as a pure visitor customer. So the ARPU implications of that are significant. Other than that, then we carry on with our direct distributor, our distributor model in Space Connect, focusing primarily on the UK and the Far East and Australia.
Just to briefly summarise on the disposal of A&K, we're obviously it's an important step for us, becoming a pure SaaS business where 99% of our revenues are now recurring. The business, the NK business, was disposed of in July for just under 1.4 million of cash, and we had net assets on disposal of 1.5 million, I think it was. The overall loss on disposal was about 250,000, and we had another transaction which came through on the disposal of an Australian subsidiary, which generated a 500,000 profit on disposal, which gives us an overall profit from discontinued activities of 270,000.
Just a quick overview of the market and what's going on. There's definitely an increase in pace of businesses contracting and reducing their real estate footprint. You probably have seen in the press companies like HSBC and Clifford Chance moving out of Canary Wharf back into the city, which in itself is significant. What's more significant, HSBC are coming to a building half the size they currently occupy. Now with 8,000 people and 4,000 desks, the only way of actually managing that is through software like the products that we actually produce. There was further announcements just last month about Lloyds and Pentland both saying that they want to shrink their footprint. So I suppose what we've seen and heard an awful lot about in the last 2 years is actually now turning into reality. Sales cycle with deals like these is still very long. There's a lot of people involved and they sort of go out and consider the market. But the encouraging thing is that there's definitely increasing demand, and we're seeing that on the ground, not just in the private sector, but also in the public sector as well. We've currently got discussions underway with a number of police forces, along with the NHS and some councils as well. So we're hoping that will manifest itself into significant business in the next year. In previous presentations, we talked about the consolidation in the market. There's a number of businesses in the US who are consolidating, where they're buying assets in this space and putting them together to create bigger businesses where they operate across different environments, from desk booking to visitor to other areas of functionality. There's been a number just recently. Appspace, a company we compete against in the US, that was acquired by Axel KKR just last month. And so that's another PE acquirer that's arrived in the market that wasn't there previously. And then we have Train Technologies, who are in the climate technology world. They bought another competitor based out of Boston just last week called Nuvolo. And that's significant from the point of view. It's the second significant trade acquisition since the summer. You might remember in previous presentations, we mentioned Johnson Controls had bought FM Systems. So consolidation is continuing, demand is continuing, and I think ultimately the emergence of prop tech as a definable sector is far more significant now than it was even a year or 2 years ago. So that's it really. In summary, you've heard it all through the previous slides. We're seeing good growth. We've got a nice focused business now where our business is software. We've got a very strong position with the number of customers we have, and we've returned to that growth rate, which I think is really important. And we compete really well against the competition. And as Chris mentioned, we've got £2 million of cash in the bank as of the 30th of September. And we're not expected to burn much cash, if any, in the coming months, and hope to be cash positive as we move through next year. So really, we're in a good place considering the general market conditions that are out there. Thank you very much for listening in on the presentation. I think the plan now is to switch across to some questions.
Yep, perfect. Frank, Christian, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated in the top right-hand corner of your screen. But just while the company take a few moments to review those questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we received a number of questions throughout today's presentation. And Frank, if I could just hand back to you just to read out those questions and give responses where it's appropriate to do so, I'll pick up from you at the end.
Okay, so we've got quite a few questions coming through there now, so we'll pick our way through those. There's one there. On a like-for-like basis, how does your pricing compare with competitors' offerings? We'd like to think that we're competitive. In the UK, there's one or two competitors who would actually be slightly cheaper than us. They might be coming in at £300 or £400 per annum. We might be £700 or £800 per annum on a like-for-like basis. On the other hand, when you go to the US, you take a competitor like Envoy, and if you took our enterprise product and could compare it to theirs, we're coming in probably at about $150, $180 a month, whereas they'll come in at about $250. We try and not rely on price for differentiation, though. I mean, a big thing for us really is customer service, speed of deployment, and we consistently score on a 60 or above on NPS. So that's a real measure of how happy our base is or not. So, but price is a challenge, but it's not our overarching thing, and we lose a little bit of business on price in some cases, but it doesn't sort of stand out as a major issue for us.
Question here: how does the functionality of your newly launched product compare to competitors' offerings? I think that Swiped on Spaces isn't far behind the competitors' offerings. It's first launched in September, and if we compare it to our Space Connect products, there's probably another 2 or 3 months' work for us to get it to feature comparity with that product. The Space Connect product is very much up there in terms of features with our competitors, and therefore we would expect to be matching the competitors with the new product in the next few months.
Okay, the next one there is: how much investment does it take to enter a new language geography such as China, and how quickly do you expect to achieve a payback on that investment? Well, when we set out on this journey over a year ago, we started with South Korea, and it had 2 objectives. One was obviously to get a flag in the sand or flag in the ground in new markets, and especially challenging markets where there are non-Roman character sets with their own challenges and difficulties. And the second thing was for us to evolve a system for rapidly and relatively inexpensively getting into new markets. And the second objective actually has been really good, because each market we went into, it's got faster. The big thing for us is that we don't have a dedicated dev team just building a product in Taiwan. We've got a really good process now for getting the product fully localized, and it really is a marketing team exercise. In terms of cost, we're talking low numbers of tens of thousands of dollars. And in terms of maintaining it, we don't have full-time staff in any of those markets. We've got some people who work for us on a part-time basis in Korea and Taiwan, so there's no fixed overhead there. And then the marketing, again, is low numbers of thousands of dollars per month compared to our major markets. So really, it's about keeping it nice and tight. And if you said, look, well, if you wanted to go into Italy next week, probably for 20 or 30,000 pounds, we could get rolling in Italy, including having a website and get the initial ad campaign. And you might remember, if you've sat in presentations from a few years ago, we were thinking in the region of 150,000 pounds per market. So an awful lot less than the original estimates.
Do you see that you will need to go to the market to raise funds in the next 18 months? No, we certainly don't. As I discussed before, we believe that the admin expense within the business is going to be stable going forward into future periods. We see that the revenue will continue to grow at the rates that it has in the past, and we'll expect to increase that in future periods as well. We've got a high gross margin, and therefore that's going to feed down and give us a position where we will be cash flow break even and cash flow positive in future periods, and therefore we won't need to raise funds.
Next one is: why not say what is the other market you are looking to go into? The product is already converted into or translated into Spanish. We haven't hit the button on that. And when for us, Spanish isn't just about the Spanish market; it's also about the South American and Central American markets as well. So we're ready to go on the product side. The question now is: do we take our attention away from what is good momentum in the US and put it into that? Because again, we've got a really amazing marketing team, but there's not a lot of them. So for us, it's about opportunity cost. But if we decided to activate, we could probably be in that market within 5-6 weeks.
Question here: why do you think the share price remains so low? We believe that it's just the general market within the UK, to be honest, and I guess globally as well. There isn't a huge amount we can do about that. But, I mean, our share price is sitting within probably towards the top end of the valuations within the UK markets in terms of an ARR multiple, but we don't think that really reflects the value of the business at all. And we don't really worry too much about where the share price is at the moment, because we believe that there is value within the business and it will come through over time as the share price moves to reflect that.
Okay, the next one was, please can you discuss if you have had any discussions directly with BIAM post their acquisition of Evoco? No, we haven't had any discussions directly with BIAM, but we have had discussions with Evoco. They made us aware of the impending acquisition back earlier in the summer, but we were obviously sworn to secrecy at that point. Chris and I have been to Stockholm recently, and we sat with the chap who is now the MD of Evoco. He's always been with Evoco, and we've had a long-standing working relationship with him. That was about a week after the acquisition was announced, and it was 2 days before the entire Evoco team went off to the US to spend a week or two with the BIAM team. Their view is, look, they want to keep it as a separate entity. They want to keep the Evoco brand, and the big challenge will be is how they filter it into the BIAM channel. In due course, we will end up with talking to BIAM directly. But the message really from Evoco is that it's all very positive, and they're excited by the opportunity and an increased reach to a much broader audience around the globe.
Customer increase to 5,100 is very interesting. Please, can you help quantify the cross-sell, upsell opportunity purely on those clients with swiped on spaces? We believe that probably around about 30% of our customer base will be amenable to taking on swiped on spaces in the future. So we believe that there's a great opportunity there for upsell to those customers. In our modelling, we assume that around about there will be adding a decent number of those customers every month, and that those will be taking around about 50 spaces, 50 assets per month, and that would potentially give us in the region of an extra 100,000 of new ARR per month as we go forward into future periods. It'll take us time to get to that level, but we see that as the opportunity available from that base in terms of growing the ARR.
The next one is, have you got individuals purely focused on upselling within the group? Yes, we have. We have a team of customer success, and their job obviously is to keep the customer happy and look after their needs, but also to start the cross-sell. And space is obviously a big opportunity for them. Up to now, the cross-sell opportunity in Swipe Down was quite narrow from the point of view we could sell them deliveries and some other add-on modules, where spaces is far more significant.
Question here, given the reduction in CAC and healthy cash balance from Anderson Cairn disposal, have you considered increasing marketing spend to accelerate growth? We certainly have, and we look at that frequently. We speak with our marketing team, and we believe that there is enough marketing spend within our budget at the moment. If we see opportunities to spend it and to accelerate that growth, we will do, but we don't think there's any real need to put more money into the marketing spend at the moment.
Okay. If the next one is, if all swiped on customers move to swiped on spaces, what theoretically would the uplift in ARR be, please? So all of the swiped on customers are on spaces now. So if they actually open their dashboard today, they'll see a section in there to say you've now got access. We give them some free spaces to play around with. So if you're on an enterprise visitor plan, you might get 5, and those spaces can be anything you want: car parking, bike parking, EV charging, desks. So they're all on it right now. In reality, we think the addressable market could be probably 10 to 20% of the entire base. Now, if you think we have a lot of customers, like we have customers who would be like schools, there's little opportunity there. Our largest customer for swiped on desks right now has got just under 5,000 desks. So it might be an outlier now, but I bet there's people within our base that could come in at that size. As Chris highlighted, though, that when we're modelling this, we've sort of been a lot more conservative in our modelling, working on the basis it would be maybe 50 assets per location. And you know, the challenge then is how many within the base would fall into that category. But we're expecting that there'll be a decent number to go for over the next 12 months.
Okay. Why do you have finance costs of £13,000 when you have net cash? The way that we account for our leases on our buildings in New Zealand, so the office where we work from in New Zealand and also the office in the UK where we work from, is by IFRS accounting, which puts it through as a interest charge and a depreciation charge. In fact, it's really just rent, but the way that it's accounted for under IFRS is those two charges. And so that's where the finance charge comes from. And also a related question, why do you incur a tax charge when you make a loss in H1? Again, that is the tax charge relating to New Zealand, where we are making a profit, and we reverse our deferred tax charge, which is the accumulated losses we've incurred in the past. We reverse that deferred tax charge, and it comes through as a tax charge. We're not actually paying that tax over to the authorities in New Zealand. It's just an accounting charge.
And the final question is, what is your medium-term target for ARR growth? Previously, you've talked about 10 to 15%. We definitely want to get back to that level. And you can see how, you know, we've got momentum back over the last few months. Now, simply by just bringing the customer win rate back to the pre-COVID levels. Obviously, with spaces coming now and more to cross-sell, you know, the potential for ARR to accelerate is high. But I think it's going to take us a few months now to get used to pitching spaces, the salespeople used to engaging, get used to the sales cycle. It is a bit more of an involved sale than a simple visitor system on reception. But the ambition is to get it back to those ARR growth rates that we alluded to previously, and hopefully beyond as well. I think that's all the questions. So thank you very much for your time this morning.
Yeah, perfect. Frank, Christian, thank you very much for that. I think you've answered all those questions you can from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Frank, could I just ask you for a few closing comments?
Yeah, again, just to say thank you very much for your support. And I think we've got a good business in a strong position. And as Chris said, we're not planning to go to the market and raise any money. We've got cash resources and a business that's heading in the right direction. And now that A&K is no longer in the group, it gives us a much more focused business going forward. So again, thank you for your time today.
Perfect. And thank you once again for updating investors. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Smartspace Software PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.